Okay, let's dive right into this. Welcome to today's Explainer, where we're going to unpack a financial theory that is, honestly, pretty shocking. We constantly hear about the billions pouring into artificial intelligence, right? Building these massive data centers, buying up GPUs, securing enormous power contracts. But what if the money fueling all of this isn't just coming from Silicon Valley billionaires or high-flying venture capitalists? What if the safety net you've spent your entire life building, your everyday retirement money, your pension, your life insurance, is secretly funding this massive AI expansion? Let's map out exactly how this theory works step by step.
So, when you see those huge headlines about trillion-dollar tech investments, who do you actually think is shouldering the massive financial risk if things go south? Is it the tech giants themselves? The big banks? Take a second and really think about it, because the answer, well, it's likely hiding right inside your own portfolio.
You are. I know, it's almost hard to believe. But through the life insurance policies you pay into, the annuities you buy for a steady retirement, and the pensions you rely on, the ultimate financial risk has quietly been transferred to the public. You see, the money you hand over every month for a secure future isn't just sitting in a vault somewhere gathering dust. It's actively being invested. And right now, a massive chunk of it is being funneled directly into the infrastructure of the AI boom.
And the sheer scale of this is kind of hard to wrap your head around. We're talking about over $1 trillion of AI debt currently floating around in the system. To put that into perspective, this represents around 15% of the entire investment-grade bond market. That is literally more debt than is held in the traditional banking sector. This is the capital being used to build the physical foundation of artificial intelligence. But why is it such a big deal that life insurance companies hold so much of this debt?
Well, it all comes down to a rule called the State Guarantee Association. Basically, if your life insurance provider goes bankrupt, the system forces every other insurance company in your state to pitch in and cover the loss. Sounds great, right? But here's the catch. They actually get that money back as a credit against their state taxes. So this bailout isn't ultimately paid for by the industry. It's absorbed by the state. And the state's money is, of course, your tax dollars.
To really understand how we got to this point, we have to peel back a layer and look at the private equity takeover of the life insurance industry. To understand their motive, we need to talk about the float. When you pay your life insurance premium every month for decades, the company doesn't just hold on to it, they invest it. If they make more money on those investments than they owe you, they keep the difference. Now, historically, insurance companies just parked this float in ultra-safe U.S. treasuries. Very boring, very safe. But after the 2008 financial crisis, interest rates flatlined for a decade. Those boring bonds paid almost nothing. Desperate for yield, insurers had to take on much higher risks just to generate enough return to keep their fixed promises to policyholders.
And that specific dynamic blew the doors wide open for private equity. These firms are always hunting for capital. Usually their funds have a 10-year life, meaning they constantly have to go out and raise new money. But when they looked at the life insurance industry, they saw a literal goldmine of permanent capital. This is money that gets topped up every single month and doesn't leave for 30 years. Today, it's estimated that private equity firms control a staggering $1.5 trillion of this insurance money. From 2009 to 2024, their ownership of life insurance assets went from basically zero to massive dominance across over 100 different insurers.
But here is exactly where a massive conflict of interest begins. Private equity firms don't just buy insurance companies, they're also massive lenders through what's called private credit. Let's use an analogy to make this super clear. Imagine your local bank makes a loan to a really risky business. Normally, if the business fails, the bank loses its money. But imagine if your bank took that exact same loan and just stuffed it inside your personal 401k retirement account. The bank collects their origination fees, their management fees, but if the business defaults, it's your retirement money that vanishes, not the bank's money. This is functionally what's happening right now. Private equity firms create loans, and then they sell those exact same loans to the life insurance companies that they own. The firm collects the fees, and the risk gets transferred to the life insurance policyholders, and ultimately, as we saw earlier, to those state guarantee funds.
So, if everyday people are left holding the bag, how are the tech giants managing to finance multi-billion-dollar AI data centers without those massive expenses absolutely tanking their own stock prices?
It's actually an incredibly clever accounting workaround. Say a tech giant, like Meta for example, needs a $30 billion data center, but they don't want that debt on their books because Wall Street would punish their stock. Instead, an asset management company builds it, and the tech giant signs a long-term lease. That lease promise makes the whole project financeable. Private credit firms then issue long-term bonds to cover the massive construction costs, keeping the debt entirely off the tech company's balance sheet. And who buys those long-term bonds issued by the private credit firms? Yep, you guessed it, the money managers acting on behalf of pensions and life insurers.
Now, if you're sitting there thinking, wait a minute, didn't we fix all this after 2008? You are asking the exact right question. After the 2008 mortgage crisis, regulators recognized the huge danger of packaging loans you know nothing about and selling them off. So they introduced strict transparency rules. Regulation AB required detailed disclosures of what was actually inside these bundled assets. Regulation RR forced the companies packaging the debt to keep a piece of the risk themselves. But somehow, astonishingly, the 2024 AI boom is entirely bypassing these very safeguards.
And this quote brilliantly illustrates why. Just recently, lawyers working on these massive AI funding deals asked the SEC if those strict 2008 transparency rules applied to their AI data center loans. The SEC wrote back with this crucial and honestly wild clarification. The securitizations of the type you described are not asset-backed securities. Why? Because an AI data center is legally classified as a building. It's a physical asset, not a financial asset that pays down over time like a mortgage. Because of this little technicality, the strict disclosure rules simply do not apply. This creates a massive blind spot. We simply do not have transparency on how good or bad these loans sitting in our retirement funds actually are.
And, the lack of transparency doesn't even stop there. The industry has adopted an alarming strategy to obscure exactly how much of this potentially risky debt is sitting in the system, and it involves moving the risk offshore. Since 2017, the share of U.S. life insurer reserves that have quietly been moved to offshore reinsurers has rocketed from 14% to a staggering 40%. We are talking about $2.1 trillion shifted to places like Bermuda. Why Bermuda? Because moving liabilities offshore provides flexible capital requirements and, crucially, far fewer public disclosures. We are practically flying blind regarding the true valuation of these assets. Which brings us to the absolutely critical part of this explainer. What happens if the music stops? If the AI stock bubble bursts? If the tech companies pull back on their massive leases and these hidden loans go bad? Who actually pays the price? Let's map out this systemic risk. We actually have a real-world warning sign playing out right now in Japan. Japan's major life insurers are currently sitting on $96 billion of unrealized losses. Now, their situation is slightly different. It's driven by holding government bonds while interest rates rise, which causes bond values to crash. But the incredibly ironic part here is that Japan actually has the good version of this problem. Their insurers hold government bonds. Those are liquid. They're priced openly on the market every single day. U.S. insurers, on the other hand, are holding private, illiquid data center loans that don't trade anywhere. Their values are dictated purely by private models. If rates stay high or the AI boom falters, the unrealized losses hidden in the U.S. system could be catastrophic. So here is the financial waterfall we've been building towards. Step 1. The AI borrowers default on their massive data center loans. Step 2. The private equity-owned life insurers who hold these bonds take the massive financial hit. Step 3, if the insurers fail, the state guarantee funds are forced to drain their resources to cover the promises made to policyholders. And Step 4, as we established right at the beginning, the competitor insurers who chip in are reimbursed via state tax credits. The math is unavoidable. If private credit fails here, the ultimate bill is footed by the taxpayers.
We're going to leave you with this final provocative thought. We built an entire regulatory system after 2008 to ensure we could see the next crisis coming. But looking at the private equity takeovers, the offshore accounting, and the SEC loopholes that categorize data centers outside of asset-backed security rules, did we just rebuild the exact same 2008 financial machine, just using AI data centers instead of mortgages and life insurance instead of banks? It's a question that really challenges the true safety of every retirement account and pension in the system. Thank you so much for joining us for this explainer, and we'll see you next time.